Hey, good morning, everybody. Happy Wednesday to you. Wanted to talk about something that got a little bit of traction there on X yesterday, specifically on GameStop. Not that there was necessarily a lot of misinformation, but there really was between the Weeble comment feed, X, many different posts, many different theories. I wanted to just talk a little bit more in depth, real quickly, just a little bit more explanation on those $95 puts for GameStop that you saw yesterday on Tuesday being traded about $18 million worth. A lot of people, a lot of different things that are happening there. So I just wanted to kind of add us a little bit more context via the video. I had talked about it briefly in the post, and I just said, let's break that down, explain. So if I sell a $95 put, I'll receive $69.30 in premium, but it's actually $6,930 as each contract represents 100 shares. It's deep in the money. So the focus there is intrinsic value, meaning that it's deep in the money. So the value of that contract is because it is so deep in the money. And it will move like the underlying stock due to the high delta of that. So the difference between the $95 strike and $69.30 for the premium is actually $25.70, which is slightly below the current market price, which was like 26. What did we close at? 26.10. The stock closed at, I believe. Let me double check. 26.04. Okay. So slightly below that. So there's a couple of options and a couple of things that could happen here. Somebody may feel that's the bottom for GameStop. That was the floor. So they're using a put position in a way, essentially, if they want the stock. And I'll explain why would you want the stock? Why would you want to be assigned puts at $95? Why would you want to pay $95 a share? You necessarily wouldn't, but you got to factor in the cost, the premium that you've already received. And I'm going to show you the math here. I've got a separate little presentation. It'll kind of hopefully make a little bit more sense to everybody here. So in my opinion, more or less just short selling and or put arbitrage could be related to, someone feels this is the bottom, so they want to own the position of stock and they're going to use this particular put in this strike. We saw this with the 125 puts a few months ago and last year. If you remember some of those deep in the money puts, traders using that, essentially, short the stock, whatever their intention was. Maybe they didn't want to alert the market to grabbing some shares, and I'll break that down more. So for example, like if this trader was assigned to buy at 95, they'd basically be buying 90 shares, at $95 each, at 100 shares, $9,500. But they already received 6,930 in premium. So essentially the 9,500, which is the cost of your 100 shares, minus that 6,930 in premium is actually 2,570. But because that represents 100 shares, you just divide that by 100, and that makes it 25.70 a share. So it's actually less than the close price of the stock. So if you went that route and got assigned, you're essentially in the stock at 25.70 a share. And the stock closed at 26.04, so you're essentially up 34 cents a share. If it was if you wanted to cover the stock because you were a short seller and you didn't want to buy on the open market, there's another way you could go around it through the option chain. So the options aren't always just one way directional. Could be hedge, could be part of a multi-leg strategy. And like I said, somebody could also just be essentially making money on the pricing inefficiency. Or related to the short selling arbitrage, a synthetic position. And what I mean by that, for example, the stock closed at 26.04. So essentially the $95 strike minus 26.04 is 68.96. So that's roughly what the premium should have been. But they got a little bit more. So, that's like the pricing inefficiency. And let's look at those puts because I had talked about this before, most recently back on April 7th. So that post yesterday where I kind of talked about these puts has a video attached from April 7th from a month ago where we talk about the $125 puts. Same kind of concept. So if you want to go back even further, and help your education or just understand a little bit more, that's also available. But let's look at those puts today, the open interest. So we saw the volume yesterday, 2,600 volume. So if each contract represents 100 shares, that represents basically 260,000 shares because you have 2,600 contracts. Each one is 100 shares. So that would be a representation of just 260,000 shares. And if you went by, current close price of 2604, represents about 6.8 million in stock, 6.8 million dollars roughly in stock. So you saw the premium there, 18 million yesterday. A lot of people posting it. A lot of people were like, "Hey, look at the 69. It's like a meme." I know everything's with a meme, but the reason why, for example, those fills were at 69.13 is because if you take the $95 strike, I know I'm going to ruin it for some people, and you take the price at the time the stock was trading, which I believe was 25.70 roughly. It was 69.30 then for the premium, so that's why. But yeah, pretty cool. I know a lot of the memes. So if we look at the open interest though today, it kind of tells this story as well. So yes, there was volume, but OI only increased by half of the volume. So what happened there? What do you think happened? Well, with 18 million premium, and these are deep in the money, exactly what you think could have happened. 1,300 of those could essentially, boom, been assigned, and trader has their shares at roughly the 25.70 average. There's a couple different scenarios. Contracts could have traded hands, so OI only changed a little bit. Assignment, market maker, etc. So let's look at that with the notes here. I want to break down that math for you. Like I said, the volume there, 2,600 yesterday, and those got alerted, on unusual whales because there was more volume than open interest. And everyone's like, "Oh, look, it's a meme, 69." I know everything's a meme. In the bid side, we're just selling puts there. You might think that's the bottom. And if we look, let's see here, let's go out 30 days on those. Because there's not a lot of data because the chain's been fairly quiet. As you can see, a little bit of volume in early April, but aside from that, again, eerily quiet. And even then, back in April, that was a few mil worth of premium, and the same thing, where you didn't see a big change in open interest, more or less stacking shares or stacking premium. So you can see the premium was about a month ago was about 70, so a little bit higher than it was. So if we zoom all the way out here, I'm gonna go as far out as I can on this, and then I'll show you the notes here. Yeah, some of those highest first fills back at 71, so a little bit less than they were. So, like I said, 2,600 yesterday, and this will make more sense when we jump over into this note here. So, for those puts yesterday, so your $69.30, basically 69.30 premium for one contract represents 100 shares. So 69.3 or 69.30 times 100 is essentially $6,930. So if that particular trader sold all 2,600 contracts yesterday at roughly, we'll call it $6,930 each for the premium, is roughly $18 million. So if we just follow me here and you'll understand the math. It makes a lot more sense once you understand the strike price in relationship to the current share price, which actually is the premium, but follow along here. So, and 2,600 contracts, like we said, because each contract represents 100 shares, that represents 260,000 shares. Now, you might think, wow, so those are in the money. I would be assigned to buy 260,000 shares in theory at $95 because that's your strike. And I would say, yes, in theory, you are correct. And you would say, wow, but that's $24,700,000. And you're not wrong. However, you already sold the 2,600 at basically $6,930 per contract. So you already received $18 million credit up front against that 24/7 charge. So if you subtract your credit already received of 18 million, that brings you to roughly 6,700,000. Now, if you take 260,000 shares and you times it by, let's say, the close price 2604 is roughly 6,770,000. So exactly a little lighter here. So they paid a little less, roughly 6.7 mil compared to the close price, which was 6,770,000. So about 70,000 less. Does that make sense to you? So if I've already sold these contracts, they gave me 18 mil. If I get assigned, I'm on the hook to buy 25 mil roughly worth of stock. There's a difference there of the 6.7, which is roughly the current market price of the stock. So there's nothing for free on Wall Street. Market makers don't give out free premium. So that's kind of what goes along here. Also, another way to look at this is the $95 strike of those puts minus the premium of 69.30 is actually your current share price at the time. So for example, the 95 strike minus 69.30 was 25.70, which was roughly the low yesterday around the time when these were getting filled. 25.67 was GameStop low yesterday. So if that makes sense to you. Alternatively, the 95, you could do the math another way. Alternatively, the $95 strike minus, I said, the current share price at the time, 25.70, equals 69.30. And that's roughly what you'll pay or receive in premium on deep in the money, as it's all about that intrinsic value. I just said 69.30, exactly 69.30. So the math always checks out. Some people, I know, it's like a light bulb going off and they're like, oh, okay, that's how in the money's priced. Some people don't realize that. So hopefully this video helps kind of explain that a little bit deeper. And so like the $95 strike means buying shares at $95 each if assigned, but you've already received a credit of 6,930. So if you had, say, you just sold one contract of these $95 puts, you're going to need $9,500 minimum capital to back that trade. Because, for example, if you're assigned, you're going to need $9,500 to buy 100 shares at $95 each. So this particular trade here isn't for somebody who's broke, isn't for somebody with a small account. Okay, so just keep that in mind. So a lot of people are like, hey, you could sell the puts. Yeah, each one of these required 9,500 in capital. So to sell 2,600, you would need this right here. You would need the 24/7 just chilling in capital to place that trade. So like I said, just keep that in mind. So like I said, your $95 striker means buying shares at 95. If you're assigned, but you've already received that credit of 6,930. So the way you would do that is, so you would have your 9,500 that it costs to buy the 100 shares at $95 each, minus your 6,930, which is your credit for selling just one contract, equals 2,570. And you'll love this math. You ready? Now you'll divide that by 100 because you remember each contract represents 100 shares. So that's actually $25.70 per share, which is exactly roughly about where they came in at the bottom yesterday. So does that make sense? 2,600 contracts represents 260,000 shares. 260,000 shares at market, well, yesterday's close, equals 6.770 mil. 260,000 shares at the 2570 going this route using the deep in the money puts puts the position there at 6.682. So a little bit less, a little bit cheaper in that regard. So depending on the scenario, but that's how that works. So I know a lot of people, if you want to pause here, take a screenshot, run the video back, reply to this video. I'll be happy to go over the math again. One of the things that I do with data is my background from college was a bachelor's and a master's degree in computer science, but heavy with mathematics and data and calculating like values of options and premium, albeit it looks scary, especially on things that are deep in the money. It's just really quite simple when you just think, in broad terms of each contract representing 100 shares. What's the current share price? What's the premium received? And very quickly you can kind of piece together that math, which is what we've done here. So I wanted to just add a little bit to yesterday's post in that regard. There's a little bit more about this in the 125 puts link to that post from yesterday with that video. So if you want to go back and check it out, you can. So like I said, I felt it was important to put out. Hopefully it makes sense to you. Hopefully you understand that in that regard. Because let's look here. What time was that happening yesterday? Let's see. Started pouring in around 12:30, 12:35. Because I was just going to go to the chart here. We'll just pull up a little 5-minute here. We'll see how that correlated with the action yesterday. Let's see here. It says when GameStop was trailing right along the bottom there, which the trader might have perceived this to be a bottom, which could have suggested, like the Bronx Viking. I follow him, good friend, also smart, So it had the same idea. Maybe that's the floor, or in that trader's eyes, they thought that was the floor. So around here is when they were loading those selling those puts. So you'd say, well, why here? Well, I'll tell you why. If you thought this was the bottom, you felt safe selling those because you're only going to make money from that position. That's the bottom line. So if you're a hedge fund, if you were short, there's a lot of different scenarios. Who needed or why? I'm just trying to give you the math and the possible scenarios of why or how. I also shared with that post yesterday. I don't know if anybody saw it. Well, maybe a few. I know sometimes the replies it gets lost with the bots. Deep in the money, how they're used in trade. I think it's important, whether it's Investopedia or any education out there. Enhance yourself. Deep in the monies, they have the intrinsic value. But one thing I wanted to highlight within this actual what I shared, with traders often look to close out deep in the money options by exercising them early. So you can doing so help clean up a trader's option position, capture more favorable interest rates in the case of deep puts. This is because owning a deep put effectively the same as being short the stock, but without being credited the short proceeds that can earn interest. So, for example, when you're deep in the money there, that's kind of what happened. I showed you there. It's all intrinsic value, and you a little bit you can get you got the stock. If your idea was to own the stock at the bottom, but you didn't necessarily want to buy the 260,000 shares, or you didn't want to alert the market. You wanted to play, you're a whale and you wanted to play a game of the market maker. You could do that also with this position. So you never know. You never know. But I'm just, like I said, I was just trying to give you how that broke down with the math in that regard. But go back to that Investopedia. I think it was important, because it adds a little bit more than maybe what I sell, deep in the money options allow the investor to profit the same or nearly the same from a stock's movement as the holders or short sellers of the actual stock, despite costing less to purchase than the underlying asset. So, and that comes into play with the math, because if you're going to buy the 260,000 shares at the $95 strike, it's 25 mil, but you've already received your credit, so you're only paying about 6.7 mil to get those shares. Well, to get those same 260,000 shares on yesterday's close, it costs you a little bit more than that. So it just all depends. But again, just wanted to add context. Hopefully it helps. You can reply below if it doesn't make sense or I need to do something more. Let me know. I covered this very extensively last year. Oh, pardon me. With the deep in the money puts. Covered it this year with the deep in the money puts as well. But felt the video would help out. So, but yeah, let me know what you think down below. Always happy to help with the data. Be heading out of town here later today. Heading over to the Major League Baseball stadium. I know, it's crazy. They allow the local high school kids to play at Big Boy Stadium, so we're going to go check that out. Gotta love it. So we'll be doing that later on today, but wanted to get that out there for you. So let me know if you have any other questions. I'll be happy to answer those. And you have a fabulous day, but like I said, a little bit more explained on those $95 puts for GameStop. The open interest change to that this morning, the impact there, how that affects the stock, what changes, what doesn't, and what it means. So hopefully it did help. Share the video, tag someone, and you all have a fabulous day. And we'll see you around the internet. I'll be lurking. Have a great day.